Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonell, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Jack Forehand is a principal at Vliet Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Vliet Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Vliet Capital or Sunpoint Investments.
So, Matt, today we're going to talk momentum.
I thought we were talking about Larry and Larry and Moe and Three Stooges. You're going to make me talk about momentum?
Yeah, momentum seems like a better thing than Moe. So we're going to talk about momentum, but we're going to have a little twist to it this time because I think people are probably sick of hearing us. We've done a lot of episodes, you and me. So we're going to bring in the big guns this time to assist us.
I think, and this is one of the coolest things about not just this show, but like the whole channel is we have all these clips. Like we have all these incredible conversations about points. I can't tell you how often I go back into the library just because I want to go find something. I'm like, remember when such and such said this thing about this, explaining this point? It's an incredible archive of notes. I absolutely love that this is here. And I love that we're doing an episode with this on a topic like momentum.
And that was what was great for me to prepare for this thing because I had to go back and pull all these clips and we've had some pretty cool people on. I mean, we had Sheridan Titman, who is considered the father of momentum in many ways, like in academic circles. We've had Wes Gray, we've had Jack Vogel, Harin de Silva. We had Pim van Vliet talked about momentum. Andy Berkin wrote the complete guide to factor investing. We've got a really good assortment of people who are going to help us get through this topic. And we're going to do it from the ground up. We're going to start with what momentum is, why it works, how it's implemented in the real world, the different types of momentum, using it with other factors. We're going to cover all of it, and we're going to intersperse clips from them along the way to help us explain all of it.
I think what's really cool, just to say this up front, is that momentum's one of those things that you kind of feel like the value investors like making fun of the technical analysts for like drawings. You're drawing pictures on charts. Like you're not actually doing any work or looking at the balance sheet or doing these things. And what's kind of amazing is if you look at data and you make sense of numbers, then it's really hard to argue academically with look at this stuff where there's statistical significance. There's actual evidence of these things working. And when you hear from a Wes Gray, when you see Titman's work, when you look at some of this stuff, you go, yeah, these are people who understand data, who understand statistics, and can put all this stuff together in a comprehensive way that says, you really can't ignore it. Were you a convert? Did you just get momentum intuitively from the beginning, or did you get converted?
Yeah, I'm still not a convert in terms of trying to understand it. I am a convert in believing that it works and believing that we should use it.
Okay.
But it's a tough thing to explain, which we're going to get into in a second. And one of the interesting things I want to say at the beginning is I was just thinking about as factor investors, our use of all the various factors, whether it be quality, value, low volatility, momentum. We use momentum way more than anything else. Because if you think about it, all of our asset class stuff, our multi-asset class stuff, where we're rotating between asset classes, stocks, bonds, commodities, all of that is momentum driven. We have trend following portfolios to manage risk. That's momentum driven. Then we've got the individual momentum stock selection strategies, which are part of the other strategies we use. So if you were to total it up, we use way more momentum than we use any other factor.
I think that's fascinating. And I think that's part of tying it back to price, because price changes the fastest in many cases. It moves more than other things. We're constantly making these assessments of how's price moving relative to this other thing and how's price moving relative to itself over some period of time. Even if we don't use the word, it's kind of like you can't talk markets, you can't talk strategy, you can't talk asset allocation without momentum.
Yeah, and they say price is truth. And I think there's a lot of truth to that. Because if you think about it, we can have our fundamental explanation for whatever's going on. We can have our academic explanation for whatever's going on. We can look at the economic data, but at the end of the day, the price is doing what the price is doing, whatever reason it's doing it. And so I think that's what's cool about momentum is you can sometimes trap yourself in these holes of trying to overanalyze everything. And momentum, there is no overanalyzing everything. It's what's happening in the market. That's it, period. And I really like that about momentum.
It's a really good feeling. So pardon my Three Stooges references. We'll come back for the other show where we just play Three Stooges clips. Make it curly. Make it Larry. Definitely make it Moe. Where are we starting today, Jack?
Yeah, let's just start about what momentum is. So a brief definition of momentum is it's buying things because the price has gone up. And that can be on one side, it's investors like that, but on the other side, they hate it. And so they like it because people love buying stuff that's going up. Like they get very excited about that. Like people want to like think they can buy, you know, whatever it is that's going up, it's going to keep going up and I can invest in that.
Yeah.
The other side of it is that,
let's be clear. We love owning stuff that's already gone up.
That's correct. Yes, that's right. We don't know if it's going to keep going up, but we love the fact that, we love, you know, people love like right now saying NVIDIA's in their portfolio, or maybe not in the past couple of weeks or the past week or so, because it's gone down a lot. But in general, over the past few years, you've certainly been very happy saying it's in there. So people love like going to the cocktail party and be like, I've got NVIDIA in my portfolio and NVIDIA's gone up a lot. And that's the reason. You know, if NVIDIA hadn't gone up a lot, they wouldn't be that excited about telling people that they own it. So people like that, but the part they don't like about momentum is they want to have some sort of fundamental explanation. Why am I buying this stuff? And there is zero fundamental explanation in momentum. Momentum just cares, has the price gone up, period. I don't care if it's, you know, because it was cheap before or because it has great growth or some economic trend. It doesn't matter. No one cares. It's only about, has the price gone up? And that can be hard for some investors, because a lot of investors we deal with have like a value bent to them. They want you to be buying cheap companies or high quality companies or something. And so they struggle with this because you have to say to them, listen, those are all great factors, but if I'm using momentum, it doesn't care about any of that. All it cares about is the price has gone up over the appropriate time frame.
My favorite Wes Grayism, which applies over and over anytime we talk about this. If we think about it behaviorally, we know that value, or we say that we think value and the value premium exist because there is a reliable and predictable overreaction to bad news. So as stuff is going down, people freak out more than they ought to. And if it doesn't go to zero, eventually it creates a buying opportunity. In the opposite direction, if you can have an overreaction to bad news, momentum works because there is a behavioral underreaction to good news, which means even though stuff is going good, even though the price is going up, there tends to be an extra period of time where people are still coming on board to why this thing is working. The numbers are there. It bears it out. Psychologically, it just means we have to talk about it. We have to talk about it in ways like this.
Yeah, and two other quick points I want to make, because I just did a media interview about momentum the other day. And by the way, the person who's interviewing me is like, do you know Matt Ziegler? Like anybody I ever talked to, they're like, do you know Matt Ziegler? So this
that guy's a moron.
Everybody knows you, apparently. Like no matter who I'm talking to, they're like, I know Matt. But anyway, so there were two things you always get in those interviews. One is basically growth. Everybody thinks momentum is growth. And, you know, that's because your average investor thinks that. And it's important to distinguish that that's not the case. Momentum and growth are very, very different. Momentum is buying stuff because it's gone up. Sometimes that can be growth companies because, you know, growth is in favor in the market. But as we saw on the backside of 2020, sometimes that can be value companies. Like, you know, coming out of 2020, once momentum was established in the value names, momentum looked nothing like growth. It looked completely like value. Like, our friend Wes's two ETFs, like QVAL and QMOM, like you saw a lot of overlap at that point because value and momentum were the same thing, but now they're not anymore. And so momentum is basically, Corey Hofstein always calls it a chameleon. It is whatever's going up. It can be quality, it can be low volatility, it can be value, it can be anything. So that's one misconception people have. The other question you always get is, why not NVIDIA all the time? Why not Google all the time? Those have been going up consistently. And the answer is because at times, those have, you know, if you kind of define momentum as like 3 to 12 months is that sweet spot of, you know, where you're measuring it. At times, those companies have been at the top of the market during that period, but at times they haven't been. So we're not using 3-year momentum here because 3-year momentum doesn't work. And so that's why you don't see a lot of those companies. And the other reason is because if you run like an all cap momentum strategy where you can put in small cap stocks like we do, you've got basically 2,700 stocks to choose from. So if you think about that, like the Mag 7 in a bucket of 2,700 stocks, there's a lot of stocks in there. And even if they have really good momentum, there's a good chance there's going to be something in there that has better momentum, especially if you're running focused portfolios. So those are the reasons you don't see them in there. But that's a question you get all the time because people think about a momentum strategy. They're like, all right, NVIDIA's in there, Google's in, what, you know, they think like the Mag 7 are in there. And a lot of times they're not in there.
The idea that it's a chameleon becomes so important, and it helps refocus us back on it's just whatever is working. Wherever there's something that's exhibiting the price change over the period of time relative to something else, and that we can say clearly market participants have been underreacting to this thing and it's propagating that trend. Why don't we, you ready to start like actually breaking down some of the fun terms?
Let's do it.
Drop cross-sectional. Get us to this fun Friday afternoon talk that we're having.
So there's two types of momentum, cross-sectional and time series. And cross-sectional, the best way to think about it is comparing assets to each other. So if I want to like invest in the stocks that have the most momentum, that's cross-sectional momentum. I would probably use something like relative strength, or what the academics would call 12-1 momentum, which is the most recent 12 months of momentum, excluding the most recent month because of the reversion of short-term momentum. So that's cross-sectional momentum. And in cross-sectional momentum, probably like the father of this whole thing is Sheridan Titman. It's funny, like if I was running, like if someone was running an entertainment podcast, like, and they were like getting their ideal guest, they might like get Taylor Swift on there. Like that was me basically when I got Sheridan Titman on the podcast, because
the Taylor Swift of factor.
This is like the nerdy Jack, so excited. Like Sheridan Titman, to my understanding, had never done a podcast before he came on with us. Like, and he is the guy who basically in academic circles there were people who looked at momentum before, but he was the one that formally, did what had to be done to prove it. And so his paper, which was called Returns to Buying Winners and Selling Losers, Implications for Stock Market Efficiency, was published in 1993. And we asked him to summarize the paper for us.
Okay, let me just first say that part of the reason why it was surprising that there wasn't a lot of research on this in the academic world prior to, the 1990s was that, at least from my perspective, this was the obvious thing to look at. Okay, any of our theories of market inefficiency are going to have some sort of story where the market either overreacts to information or underreacts to information. If the market tends to underreact to information, you expect to see continuation. Stock price goes up, from 10 to 15, but it was an underreaction. So then later it goes up from 15 to 20. Or it could be an overreaction. It goes from 10 to 20 and then back to 15. So from our perspective, that was sort of the obvious type of test that you'd want to run if you want to think, as first principles on market efficiency. Does the market react appropriately to information? Okay, so what we do in that paper is we look at lots and lots of different intervals. We're looking at different holding periods and different formation periods. So we would look back 3 months, rank returns based on the past 3 months, hold for the next 3 months, hold for the next 6 months, hold for the next 9 months, hold for the next year. Then we look at a look back period of 6 months. And again, looking at returns at 3 months, 6 months, 9 months, and a year, and so on and so forth. So we looked at, lots of different intervals and then did a careful statistical test that would control for the fact that we're doing some data mining, and then ask the question, do we find more excess returns in all these strategies than we would expect from chance? And the answer is yes. We could very soundly reject the hypothesis that returns were basically following a random walk.
I have to say, Titman clearly, if not the Taylor Swift of momentum papers, close. Maybe the Max Martin. I don't know who he is behind the scenes, but epic work.
That was a really cool one to do. So
who got next? Yeah, and keep the hits coming.
Yeah, so we're gonna switch to the other kind of momentum now, which is time series momentum. And the way most people see time series momentum in the real world is what we talked about before, trend following. So you'll see portfolios, if you're thinking about like something like a simple S&P 500 trend following system, if it's below a certain moving average, you're out of the S&P 500. If it's above it, you're in the S&P 500. That's the general idea of time series. So with time series, you're comparing the asset to itself. If I'm using the S&P 500, all I need is the S&P 500's prices. I don't need to know what the Nasdaq's doing or what the Russell 2000 is doing. So in this clip, we asked Jack Vogel, who can obviously explain it a lot better than me, from Alpha Architect. Here he explains what time series momentum is.
So again, sometimes trend following is called momentum as well, right? But let's just clarify. So momentum, what we talked about before, is we have 100 stocks. We're picking the top 50 because they did well, right? Trend following is I'm going to look at one asset, right? So I'm going to look at S&P 500. Is the S&P 500 trending up or is it trending down, right? And I think that's the simplest way to bifurcate is basically trend following is my single asset or the one, it is the single asset that I'm looking at. Is it trending up or is it trending down, right? And there's different ways in which you can roll it. So the first way is called moving average rules, right? And a moving average rule is you look at the last price and you compare that to the average of the prices over the past 12 months, right? If you're doing monthly data or 200 days or 250 days, right? So that's a moving average rule. Another way you could look at it is what's called time series momentum, which is you just look at the past total return over the past year or 10 months or 9 months. Compare that to the return to cash, or you can compare it to the return to just zero, right? Whatever you want to set as your risk. If your return of your asset is above the return to cash, you're invested. If it's below the return to cash, you get out, you go to cash. So trend following is a simple approach to effectively be in or out of an asset class from time to time, depending on the trend.
What's interesting to me about like time series momentum, when I think about it, when I think about trend following in general, is it's one of those things that on paper, like makes the most sense in the world. Like if you look at anybody, like Meb Faber wrote, I mean, people have done it before him, but he's written, I think it's the most downloaded SSRN paper of all time in this area, I believe, in finance. I don't know if that's true, but I think it was.
You're talking about the one that came out right after the financial crisis, right?
Yeah.
The 12-month moving average or 10-month moving average,
where he
200-day
basically
moving
introduced
average one.
this idea.
Yeah.
But what's interesting about it, so if you look at that paper, you look at anybody's other papers, what you're going to get basically, if you just did a straight trend following thing with the S&P 500, just, sell below a certain moving average, buy above it, you're basically going to see similar returns to the S&P over the long term, give or take. Some people say a little bit more, some people say a little bit less. You're going to see that with like half the drawdowns or something like that. So in theory, you're like, wait, the same returns with half the drawdowns. This seems like the greatest investment strategy of all time. Like everybody should be invested in this. And the challenge is it's very, very difficult to do in the real world, because a lot of times, you'll be out of the market when the market's going up. And one of the nature of these types of things is you have to have a lot of false signals that are small usually in order to get the really good one. So basically in 2008, most trend following systems were out altogether of the market. So you saved almost all of that decline. But since 2008, there's been tons and tons of false signals. So it's underperformed since 2008, but it saved you just like 40 or 50% in 2008. So net, you end up somewhere similar to the market with less drawdowns, but behaviorally, it's really challenging.
It's really cool to have these words too, like the whole idea of like cross-sectional versus time series, because it allows you to start unpacking the way other people will talk to us. So sometimes in like the advisor seat too, and talking to clients about this stuff, when you hear things like, time in the markets is more important than timing the market from the salespeople, and you hear these expressions, you can start to contextualize them. So something I see all the time is like, let's pick on the idea of I own this and something else is going up. So if it might be across baskets. It might be I own stocks and bonds are going up, or I own bonds and stocks are going up, or something like that. Now you have to step back and go like, okay, they're actually talking on cross-sectional terms. This is a relative measurement to how one thing is doing compared to the other, which is one way to think about risk controls across this using the language of momentum. Likewise, when the market is puking, and if you came out of stocks or something and you say, okay, great, this is a time series momentum argument. I understand that if I'm using a moving average, if I'm using trend following, if I'm using something that's only looking against itself, how's that comparison being made? People will flip back and forth between these things. I really loved learning these words to be able to articulate them. On top of that, I do have to say, one of my favorite things I know I learned this from Meb, but I feel like I also got this from Underdiscussed, Stocks for the Long Haul. Do you have your copy of that book somewhere on the shelf in the house, I hope?
Yeah, Stocks for, yes, definitely.
Yeah, you got the appendix in Stocks for the Long Haul, the epic growth fundamental investor book, and it's got a whole section on the 200-day moving average at the end of the book. I always thought that was fantastic. So in there, I'm pretty sure Siegel, Anna, I know Meb definitely wrote about this too, where it's like the time in the market versus timing the market thing. The best and worst days tend to happen when the market's in a downturn. I love that statistic. That makes me happy. That just makes me happy for trend followers everywhere. That when the market's below its 10-month moving average, it tends to be more volatile in general. And therefore, that's why those stats bear out that you discussed earlier. You can't go lever it up because you have to survive, but it's super interesting to dive into all this data and think about how it changes the language we use when we talk about it.
So you like these terms cross-sectional and time series to use with clients, but I've got a new one for you to use. And
joy.
Wes is going to explain this here, but the new term for you to use with clients is buckle up buttercup. So Wes will explain why that relates to what's going on here at trend following.
And that to me is just common sense, because it's not hard like anyone with half a brain and Excel spreadsheet can go do back tests on trend following on every asset class that's ever walked the planet and be like, holy cow, I basically get most of the return with half the drawdown. I should do that. It's like a duh, right? The problem is that's not the hard part. The hard part is sticking to it in the behavior. And so that requires like a deep understanding, a deep endowment effect, and a deep appreciation for just how bad and just how ugly and painful this whole like relative performance and like careerist thing can be. Like people discount that too much. And so, well, if you want to solve that, just run towards the fire, right? Like let's just directly address the elephant in the room. This sucks. Buckle up, buttercup. That's just how life is. And we're just going to tell you how it is. And if you're cool with that and you understand it, well, guess what? This is the greatest idea that you'll probably ever run across. And welcome to the team. But if you can't get your head wrapped around it, like it's not going to be a good fit. Even if it's the best idea on the planet, for certain people, it's probably the worst idea on the planet. And that's cool.
So yeah, you alluded earlier to this idea, and I think this is a good time to cover it now, which is this idea of why does momentum work? And you alluded to the behavioral explanation. So I think it's good for us to just, we always like to go back to the academic world whenever anything works in the market and say, do we understand why it works? And we'll talk in a second about why that may not matter, but let's just first go with the explanations. So with any factor, there's usually two reasons it would work. One is the risk-based explanation, which means it works because it's riskier. So value is a good example of that. People think that's at least part of the explanation of value, which is if you're investing in value stocks, they typically are riskier than the market. You'd expect to extract a premium for taking on that risk. Momentum is more likely explained by the second one, which we'll get into in a second, but behavioral explanations are there's something going on in investor behavior. So for instance, with momentum, the idea would be investors underreact to good news. With value, the idea would be investors overreact to bad news. And what that does is that creates a mispricing. And so then if you buy a basket of those value stocks or a basket of those momentum stocks, when that corrects over time, you benefit. So there's debate as to all these factors, whether it's value or momentum, as to which one is right. Or both of them right? We don't know. So we asked Sheridan Titman to explain with momentum, which one does he think is correct?
No, it's behavioral. I don't put much weight on the rational stories. I mean, you can always come up with a rational risk-based story, and maybe there's something to that, but this is mainly a behavioral issue. I have a very recent paper where we look at Chinese A and B shares. Are you familiar with that, the A and B markets in China?
Yes.
Okay, so they're exactly the same stock, basically. They both trade in China. Okay, but the A market is basically the domestic market where you use the local currency to buy the stock. And in the B market, you need access to US dollars or Hong Kong dollars to buy the stock. So the stocks don't exactly move in the same place. The dividends are identical. So it's the best experiment you can have in terms of basically saying, I want an experiment where the return differences have nothing to do with the fundamentals of the firm. It has to do with the moods and views of the actual investors. And so what's interesting is that in the A market, there's no momentum. That's kind of well known. People talk about the fact that in the Chinese market, you don't see momentum. And in the Chinese A market, you see pretty strong reversals. Now, the B market, exactly the same stocks in the sense of exactly the same dividends and exact same fundamentals. Okay, but those stocks do in fact show momentum, and you don't see reversals in those stocks.
Yeah, so this one was really interesting because he's looking at China. I actually had never seen, and I know Wes had tweeted after this, he had never seen this either, like this paper he's talking about. He had written this paper about China A and B shares that we had never seen before. But the idea is he was looking at the A market, which is the local market in China, and the B market, which is like the dollar market. And he was saying, looking at both of them and saying, does momentum exist? And what he found is in the A market, it does not exist. And in the B market, it does. And to his point, he was just saying on there, they're the same exact stocks. There's zero difference between these things. So if there's zero difference and there's momentum in one of them and there's not momentum in the other one, it can be a pretty good argument that this is really a behavioral thing, which is what most people think. I mean, most people think who have followed momentum, most people buy into the behavioral argument for momentum rather than the risk-based one.
I think so. The explanation, which is more in language terms than anything else that you just requoted again, that value, the overreaction of bad news, momentum, the underreaction to good news. It's okay to step back and not use the $5 words, to step back and just think like in human terms. If somebody else has something, like if you were eating a bowl of ice cream right now and I was like, oh man, that looks really, really good, and I covet thine ice cream, like that's okay. That's just me going, I see something that I do not have that now I want some that somebody else has, and I'm going to go run into that thing. And in economic realities, that possibly pushes the desire for the price of the thing up. Likewise, if I already have a bowl of ice cream and I'm like, this is the greatest thing ever, I want another scoop, it's another version of the same thing. We're human. We're susceptible to stuff that we want and these desires. The China A-share, V-share example is just like mind-blowing to see it play out in a space like this. Just wild, wild research.
Now you've made me want ice cream. Now I'm going to have to go off. It's the middle of the day here. I haven't had dinner yet. Now I'm going to have to go get ice cream, Matt. What have you done?
Let's ruin some dinners. What else is momentum investing for?
So back to this point of behavioral versus risk-based, it was interesting. We had Andrew Chen and Alejandro Lopez Lira on excess returns, and they talked about this. And we're going to introduce a quote from Wes in a second, but they talked about this idea that all of us who are factor investors have had that like hammered into us, is there needs to be an explanation. It needs to be a risk-based, a behavioral-based. If you want the thing to persist in the future, it's got to be explainable. And so we've lived our whole lives that way. And they wrote a paper that effectively challenges this entire idea. Because what they did is they took the factors that had risk-based explanations, they took the factors that had behavioral explanations, and then they just data mined a bunch of factors, which were like dividing stuff on the balance sheet and the income statement that on the surface, at least, you would think have nothing to do with each other. But they held up in the data. So they used these data mine factors. They put them in 3 buckets, and they said, all right, we'll test, to where Fama and French did in the early 90s. Going forward from the 90s forward, how do these hold up? And what they found is it was basically a wash, and if anything, the factors that had zero explanation outperformed all the other factors. So, which is just crazy to think about, because we've been trained that, we need these explanations. And they found, and this is kind of, to me, is a groundbreaking paper, they found that maybe all of that is wrong.
It makes me feel like all the time, all the probably years at this point of life that I've spent going to the spurious correlations website to just say, I could prove the rain in Indonesia falls at a higher rate when there's more Nicolas Cage movies or whatever it is. This is just a wild application of data mining and just making us question the things we believe in, which I view as a really healthy exercise. I love that they said, let's take it to this level and test these ideas.
Yeah, so I'm going to invite you to invest in my new accounts receivable divided by cost of goods sold ETF. It's a beauty. It tests really well. People are going to
lever it up. Can I get it to
the market's going to embrace it. We were actually joking with them, like the only people that would probably do that would be like academics. We could probably get a bunch of academics to invest in that because they would have seen their research and they'd be like, oh, actually, these factors that make no sense might be better than the ones that are out there.
Good thing academics are known for being insanely wealthy. I'm sure it's going to do wonderfully.
So we asked Wes about this. So here was Wes addressing this paper and this whole issue of, does it matter whether factors have an explanation?
Yeah, I've kind of come to understand. I don't think anyone knows how any of this stuff works. And actually, there's this brand new paper. I'm blanking on the guy's last name. His first name is Andrew. Where he has this paper that's kind of like debilitating. Because my whole life, as a Chicago school PhD, you learn like, hey, theory, narrative, like financial economics, you need first, and then you do empirical studies because you want to avoid data mining, right? And just making something up because it sounds good. And then this guy basically says, listen, we looked at all the peer-reviewed papers, and some of them have super convoluted theories backing up the thing. Other ones have mispricing theories backing up the thing. You could also just data mine this stuff. And guess what? They're all the same, right? He basically, what he results says is like, I could either data mine what works and add a sample. It's going to work a little bit worse than it did beforehand, but it'll continue working. Or I could have this like 50-page like physics envy paper backing up the theory of why it works and look at the results. He's like, it's all BS. In the end, data mining achieves the same victory, which I don't know what to think about that, honestly, but it going to this point, like, does it even matter why it works? All we know is it's empirically in that data and it's real. So let's just do that.
So before we wrap up on this part, I just wanted to mention one other thing, because you used some words with a lot of syllables in the last podcast, and I felt bad that I didn't get to use words with a lot of syllables. So I'm
How
just going
many
to say
syllables we got?
reflexivity.
Oh, nice.
So this is So this is another way to explain why momentum works. And yeah, so how many is that?
Yeah, reflexivity. Are we doing 5? I mean,
And I forget. I mean, you might have used 7 last. I'm not sure how you got to a level that yeah. I may not have matched you, but anyway, I think this is a cool explanation of momentum. So I always like to throw it in when we talk about it, which is this idea that like good news begets more good news. So I always like to use the idea of Tesla as an example of this. So basically, everything that Musk was doing with Tesla, like drove up the stock price. And what happens when you drive up the stock price? You can issue more stock. What else happens? You can attract much better talent because you can pay the people with stock. The positive news around the company grows, so you can get other people to invest. So it's the idea of just the price going up on its own can create this chain of all these other positive things for a company, and that can contribute to momentum. So, I mean, you could argue, remember like the 420 tweet he had, like price, what was he like selling it? And he claimed he had 420 a share or something like that.
funding secured.
Secured 420.
Masked
Right?
in a pot joke. Yeah, fantastic.
Yeah.
Gotta love it.
So, I mean, you could argue at that point, Tesla, and I think he's admitted after the fact, Tesla was on the verge of collapse. So, like his ability to shape the narrative and drive up the stock price, you could argue saved Tesla as a company altogether, and then it generated all these other positive things that happened. So that's the idea of reflexivity, is if you get the stock price going, all these other benefits come to a business, which may not have otherwise come purely because you've driven up the stock price.
It's fascinating because reflexivity is one of those things that, again, you can see it places in real life. You can see it in the story of Tesla and sort of the feedback loops that this introduces, but you could see it in, I don't know, you could go watch like a U10 soccer game or a U6 soccer game and all the kids clustering around the ball. Wherever the ball goes, like the herd falls apart and comes back together. This is just this idea of these feedback loops get created, and you can really spin them up in kind of a wild way. Once they show up, you can keep winding them up, and sometimes that's the only way to explain the behavior we witness in a marketplace.
So we talked about pure momentum. Let's talk about some ways to maybe enhance a momentum strategy, because there's some cool stuff you can do. I mean, there may be less ways to enhance a momentum strategy than everything else, because with value, you've got all kinds of different stuff you can look at. You know, with momentum, you've basically got price, but within price, there are some interesting things you can do. And one of them is this idea of momentum consistency, which is this idea that if momentum is more consistent, do the stocks perform better than if you've got like the biotech where it just went up a lot on one day? So we asked Jack Vogel from Alpha Architect to address this. They addressed this in their quantitative momentum book, and here's what he said.
Consistent momentum is just effectively, and we embed this in our like index and in our strategy, effectively, the one paper that we use in our indexes, it's called Frog in the Pan, consistent momentum. And basically what they're looking at there is they wanted to see, is the momentum premium driven by firms that have like kind of more consistent momentum or ones that have like jumping momentum. So the example and why it's called Frog in the Pan is, you know, if you throw a frog into a pot of boiling water, it's going to just jump right out, right? Because it's going to identify this is boiling water, I'm going to jump out. If you throw a frog into cold water and slowly turn up the heat, it's not going to realize, and eventually, unfortunately, it's going to die, right? So in this study, in that paper, what they did is they looked at basically the different types of momentum. So, you know, I always use the same example. You have boring big box, right? And boring big box is a high momentum firm because it basically was up 50 basis points for 200 days. So it's up 100% over the past, 10 months. Alternatively, right, we have exciting biotech. And in exciting biotech, right, it's just kind of jumping around. And then 5 months ago, it got FDA approval and it jumped up 100%. And it's been literally flatlined since then, right? So in that paper, and, we've studied this as well, a couple, replicated it, changed the universe, and it seemed to work as well. Essentially, you want to be buying the high momentum names that have more consistent momentum, right? And that spread between high and low momentum is generally driven by the more consistent, both good and bad momentum, right? But on the high momentum side, we want to look for firms that basically have high momentum, and they also have this consistency.
Yeah, so and one other one I wanted to address, I mean, the consistency one is a really good one. We run that quantitative momentum strategy on Validia that they put in the book, and it does. I mean, it enhances momentum, and it makes sense to me too. Like I was thinking if I'm going to buy a business, I would want it to be more up in a straight line than, if the biotech made its 1,000% return on one day and then was down the rest of the year. Like, do I really want that in my portfolio, or is that a sign of like good news that's going to, the people have underestimated that's going to continue into the future? Or is it better if it's kind of slowly grinding up? And I think he's right about that. I mean, I think the consistency is a better way to look at it.
I think it's a great way to look at it. It's it's another kind of like intuitive sounding thing. If you're using that consistency as an indicator, you can understand why that story would be powerful and probably show up in price.
And another thing we've looked at is this idea of fundamental momentum, and people disagree on this. So the idea is, well, what if I don't just look if there's momentum in the price? What if I look if there's momentum in some group of the fundamentals? And so you'll have an argument on both sides of that. Like the price momentum people will tell you, well, that fundamental momentum is reflected in the price. So there's no reason to add fundamental momentum to your strategy. Like over time, you see those track pretty well together. So like it's already reflected in there. There was this paper by Dashan Huang called Twin Momentum that looked at this. And basically they found that they got significantly better excess returns. They had like 7 fundamental variables. When they looked at that and coupled it with the price momentum, they got better returns. So I'm not going to settle the debate here, but I think it's an interesting thing to think about. And also I think one of the things I like about Twin Momentum is I think it's a little bit better behaviorally, because going back to what I said at the beginning, if investors don't want to invest in stuff purely because the price has gone up, if you can say to them, well, you're not just investing because the price has gone up, you're also investing, here's these fundamentals we're tracking. Even if the performance is the same over time, you might get better like buy-in from people to it because they like the idea that they can look at fundamentals going up along with the price.
I think this is really interesting too. And I love where the Twin Momentum stuff lands, because there's echoes of stuff from I know of it from like the 90s and early 2000s that like Richard Bernstein and Savita Subramanian and like Nigel Tupper and those guys were all doing, where they were looking at this stuff to try to help inform active equity managers running fundamental strategies and going like, look at things like earnings beta, look at things like revenue momentum or other fundamental indicators and ways that you can see through this lens. Because behaviorally, that might be the thing that helps you stick to something when it's in some crazy advancing cycle or some crazy declining cycle, and you're trying to figure out, how do I make sense of why I'm sticking to this thing?
So yeah, and we've talked about a lot of positives with momentum, and whenever we do any factor, I always like to talk about the downsides as well. So to me, there's 2 big major downsides of momentum. One is definitely its higher turnover. So if you think about it, like if I'm buying a stock because it's a value, because it's cheap, that's likely to be a signal that has a longer duration to it than if I'm buying something that has momentum. Because if that momentum reverses, I'm going to want to get out of that stock. So momentum just versus like a factor like value, it requires more turnover. It's going to require more transaction costs. If you're in a taxable account, it's going to have negative tax consequences. So that's one thing to keep in mind. Obviously, if you're investing in an ETF, you don't really care as much about the tax part of it because the tax gets rolled into the ETF, but it's just something to keep in mind when you look at momentum. And the other thing is, momentum can have trouble at turning points. So if a certain type of stock is leading the market and then you get a major reversal where another type of stock is leading the market, it's going to take time. I mean, think about it. It's using, 12 months of returns or 9 months or whatever it's using, but it takes a little bit of time for that to show up in those 9 and 12 month returns. And in the meantime, you're in the wrong stocks. And so you can struggle at these turning points. Momentum where the same type of stocks are leading the market, that's where momentum can be great. Turning points, it can be a little more challenging.
The turning points gets you every time, right? Everybody wants to go 100 miles an hour down straight away. But eventually there's a turn. And if there's one thing we know with markets, there's going to be a turn. So just having a system so you don't slam into the wall is kind of the name of the whole game.
Yeah, if there's one thing we know with every factor, is they're always going to have these periods where they don't work. And we've seen that more with value than we have with momentum in recent years. But to me, it's really, really important to talk to people up front and say, like, here are the problems with this type of approach, because there aren't going to be approaches without problems. So it's just important to address that up front and say, here are the types of markets where you might see a problem here, because if we see that type of market in the future, it's still, people can say whatever they want. They're still going to be upset when they're underperforming. But at least if you can say, like, a big reversal is going to be a problem for momentum, and then someone invests in a momentum strategy and then you get a big reversal, you can say, this is an example of what we were telling you. So the next thing I want to talk about with momentum is this idea of going back to this idea that every factor struggles. Is one of the ways you can deal with the fact that every factor struggles is you can use factors together. And I don't think there's any better factor to combine with other factors than momentum, because going back to that idea of price is truth, if value is struggling, and I can overlay some momentum where maybe I'm getting in some better value names, or maybe I'm using it for the entry and the exit into value. There's so many ways I can do it, but momentum makes a ton of sense to me in combining with other factors and building a multi-factor portfolio. And so the first clip here, we talked to Andy Berkin, who wrote The Complete Guide to Factor Investing along with Larry Swedroe, and he talked about this idea of using momentum with value.
We always like diversity. And so including other factors that affect the returns of stocks that we believe in, I think that can be quite a good idea. Now, how does one do this? Well, if we take for example, momentum, one finds that, stocks that, deep value stocks, in some cases, they're stocks that are cheap. And then you have other stocks that have become cheap. And there's an expression, you want to watch catching the falling knives. That is, there's stocks that have become cheap as the prices have gone down, but they may keep on going down. And that's basically what momentum is all about. So taking into account momentum, for example, by avoiding buying those stocks that have been coming down in price can certainly add to one's returns or help one's portfolio, keep the momentum exposure from becoming super negative, which is a characteristic of strictly value portfolios. They tend to have very negative momentum, which historically has not done that well. Additionally, with your value stocks that have been going up, that have been recovering from being beaten down, for those that have got very high momentum, maybe holding on to them for a bit longer. Momentum is a very quick acting factor. So, avoiding buying those extreme losers, holding on to your winners a little bit more helps.
Yeah, and it's not just value that works well with it. It's also basically all the other factors. So we had Pim van Vliet on, who is, one of the best experts I know in low volatility. And his strategy he wrote in his research paper and in his book is a low volatility strategy, but it introduces these other factors. And one of those factors is momentum. So he talks here about how he uses momentum to supplement his low volatility strategy.
So in the screen, we use momentum and income yield, so payout yield. The beauty about adding those is a couple of reasons. First, your return goes up, your absolute return significantly. But the second thing is that also your tracking error also goes down. So the stability of your outperformance really improves. And that makes it that's very important that you get capital growth and capital protection. That's the twin desire of any investor. And it has become a bit less at the forefront. But yeah, going forward, like you said, just in the start, this is going to be very important. Because, for example, why I like momentum a lot is momentum plays the underreaction theme. Momentum standalone is very difficult to arbitrage because it's such a high turnover strategy, but it's beautiful to blend into a low vol approach because especially combined with value like income, these are antagonists, so they are negatively correlated. So you can blend them in very easily in a defensive approach. It goes very natural. And what we see is that the conservative formula is clearly much, much better than a plain low vol approach. It is giving higher alpha, higher Sharpe, lower tracking error, higher information ratio, and also what you mentioned in the beginning, better inflation protection. Because low vol itself is already pretty decent in that, but especially with these additional screens, with momentum, you get much better inflation protection with the formula. Now, besides the book, we also wrote a study in the Journal of Portfolio Management where we drilled much deeper into the formula and also relating it to all kind of robustness tests, checking it outside the US. So it also works in emerging markets. It's very robust. Also in Europe, in Japan, transaction cost analysis. So we really grill and drill on the formula whether we can shoot holes in it. And in all cases, we see that adding value and momentum together really makes the strategy better. That in some markets, value might be a bit better.
So I think in the real world, like those last two clips are some of the most important for people to look at, because at the end of the day, I don't think anybody, as I've said in the podcast many times, I think a lot of people probably shouldn't be factor investors at all because it is tough to deviate from the market. But I think people who are factor investors, who do believe in these long-term premiums, it's almost always better to use them together. even if you're a big value guy and I love value and I'll ride it to the death or whatever, usually you'd say that and then you get the 10-year period where value struggles and you just can't do it. It's very, very hard to do in the real world. So I'm a big believer in blending these strategies. And I think momentum is a really good way to do it.
To me, this is thinking diversification. This is the kind of thing where if you're a value guy, introducing momentum into your process, it just gives you a devil's advocate. It gives you another perspective that's going to deliberately contradict you at various points in time to make you ask, why do I think this makes sense? Why am I fighting against this? And in some cases, how can I improve my results by just having a consistently diversifying point of view or perspective? The fact that momentum pairs so well and shows up in so many different places as complementary, the Asness paper, the Value and Momentum Everywhere, that really shaped my thinking years and years ago on this too, is just, it's really eye-opening. And it's really good to have that diversity of thought inside of your process. That's probably one of my favorite parts about the momentum literature, is just how many different places it can help explain or help you give depth and nuance to the conversation around, here's the factor I'm pigeonholed into, but here's this other reality that says, think about this too. That's useful.
Yeah, and it gets back to that price is truth thing. And your point made me think about this idea. We use momentum. One of the places we use it is in a negative screen. So for value strategies, so you have your value screens and you say, oh, this stock is cheap or this stock is cheap. But what we try to do is many times they're what you call a value trap, meaning that they look cheap, but there's something going horribly wrong. And we have some, balance sheet based stuff we do. We'll look at like earnings estimates. We'll look at a bunch of stuff to do that. But to be honest, the best thing we use is probably momentum. Because if I think this is the greatest, cheapest company in the world, but it has a relative strength of 1, so the market tells me it's in the bottom 1% of all performers, there's probably something going on I missed. And so what we do is we'll have this negative screen where we'll screen those type companies out of our value strategy. We won't screen companies with like momentum or relative strength below 50 or something. We obviously understand part of buying value companies is sometimes they're not going to do well. But if they're at the absolute bottom of the barrel, if they're the worst performing companies in the market, there's probably something going on and we probably don't want to own them. So that's an example of where we use it. We'll use it to like screen out on the negative side.
One of the quantitative value investors I got to work with for a while, one of their big things was actually cutting off the tails. And that was the way they used momentum. They didn't use it to actually make any portfolio decisions, but they used it to basically say, if something is ripping with positive momentum, it falls into a special category of critical thought and analysis. And likewise, if something is getting just absolutely destroyed through the floor, annihilated, they would go, even if it's screening amazingly on all of our value scores, we have to think of it totally differently when it falls in these top and bottom deciles or whatever their tails were. I thought that was so interesting. Even though it wasn't driving portfolio management decisions, it changed the tone of the conversation when stuff got into those extreme settings. So useful.
Here's one more thing I want to touch on before we close up here, which is this idea of factor timing. And everybody wants to do this. So the idea is I can use some sort of system and I can say, value is very attractive right now, so I should put my portfolio in value stocks, or quality is very attractive. And in general, the research will tell you this is exceptionally difficult to do. And if you're going to do it, as Cliff Asness said, you want to sin a little out. He didn't use it in that context, but that is basically what you want to do. You want to be very, if you're going to do anything with factor timing, you want to do it in very small increments. But the reason I want to bring it up here is because when we've looked at factor timing, we've looked at doing it in a bunch of different ways. We've looked at doing it based on value. So if the factor is cheap, you do it. We've looked based on economic stuff. So, if inflation is present, you want to own this factor versus the other factor. And then we've looked at it doing it based on purely on momentum, which is just whatever's going on. And I think it's pretty clear when you look at that momentum is the best of the three in terms of factor timing. And so that is a use of momentum. And I wanted to introduce this clip here because we interviewed Harin de Silva a long time ago. And this was a really interesting clip because not only does he use it at the factor level for timing, but he actually uses it at the metric level. So he's looking at it and saying, does the PE ratio have momentum? Does the price to sales have momentum? And he's able to build a portfolio using that. So I thought this was a really interesting clip to talk about that idea.
So this goes back to my my kind of introduction to quant investing, where I was looking at individual managers. And what I noticed that the managers of a certain type, managers who focused on dividend yield, managers who focused on earnings growth, for example, they all tended to rise together, and then they stayed at the top for a while, usually 1 to 3 years before they got out of favor. And it's not that the managers got stupid or lost their edge. It's just that the factor they were loading out went out of favor. And that's where I noticed that factors, just like fashion or music, they go in and out of favor. And often it's really important to identify which factors are in favor and then emphasize that in the portfolio. So I find that factors that have been in favor for about a year have the most importance. 2 years, less important. And after about 3 years, factor momentum tends to die away. And Jack, when we first started doing this, I would say, 25 years ago, we would get a raised eyebrow when I went to talk to consultants about it, saying, are you talking about timing factors? And I would say, no, it's not about timing factors. It's about recognizing that the factor risk premium changes over time. But more recently, there have been more and more academic papers that have talked about this, and they've really documented this whole idea of 1 year factor momentum. And, it's been really rewarding to see that.
And do you do it at the metric level as opposed to the factor level? So in other words, if it's not value has momentum, it's price to sales has momentum. Do you do it at that much of a granular level?
Yeah, we do. Yeah, I think it's really important to do it at a granular level. So for example, from a quality standpoint, everybody thinks of operating margin, but there's other factors like ROE, which have gotten really important recently. And you have to do it at that granular level to actually get the best use out of factor momentum.
So yeah, Matt, to wrap this up, I think momentum, to me, is one of the best factors that exists. I don't think it gets the respect it should get, but like if you look at how it works over the long term, it's really good. If you look at it in terms of like the amount of 3-year periods it has that it struggles relative to the market, the amount of 5-year periods, like if you looked at all rolling periods and said, what percentage of time does it struggle against the market? It's actually better than value. It's more consistent in terms of generating outperformance over 3, 5-year, even 10-year time periods. Basically everything about momentum would say this is something that makes sense, but it just can be hard for investors to wrap their arms around it. They just like saying, I want to buy this cheap company. I want to buy this high quality company. So my general conclusion on momentum is this is something more people should use in their portfolios. And it's also very, very flexible in that you can use it in terms of full on momentum. Like I've got a bunch of momentum stocks in my portfolio. You can use it for entry and exit. You can use it to rotate among asset classes. You can use it for trend following to manage risk. It's more like the Swiss Army knife of factors to me because it can do so many different things.
Larry, Curly, and Moe, the Three Stooges. It's friggin' dumb, but it works. It's funny. It doesn't have to make perfect sense to you. Like the data is here. We've got all these clips. We've got all these really smart people who are telling us different ways to apply this. Don't ignore it. Just enjoy it and figure out ways to apply it to your thinking. It fits in as much in the portfolio construction, the security selection level as it does for asset allocation, as it does for just thinking about the behavioral biases that are inherent in our thoughts, and as we put these operating procedures and everything else together as we run money. So I think it's intensely useful. This is one of those factors that I'm delighted when we said, let's come up with some clips, and we're scratching the surface at the number of intelligent thoughts we could do on this topic. That is so cool to me.
Well, if nothing else, the IQ of the podcast rose substantially today relative to what it normally is.
The Two Stooges here on this episode. Yes. I would say
yeah, so if anybody has any feedback, definitely let us know. We want to do a little bit more of this stuff where we mix in some of the, we know people can't watch all of our excess returns interviews, so we want to mix in some of this around certain topics. So if anyone has any feedback, definitely let us know, excessreturnspod@gmail.com, or write a comment below. We appreciate everybody joining us, and we'll see you next time.
Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbonneau, and follow Matt on Twitter at CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.